Well, let's get into Paul Harris's Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right, Paul, your first pick here is a Mag 7. It's Alphabet, which, owns Google, owns a bunch of other things. Why do you want to buy it here?
Well, so I think Alphabet is the most undervalued tech stock around. It trades at 20 times earnings, below the market multiple. It has, kind of so many levers of growth, whether search is not going away, and even AI search they talk about all the time, but search is still a very big thing. When you look at YouTube, continues to grow. I mean, if you want to
we love YouTube over here at In the Money.
Like if
That's
you want to
where
build
we're
anything, you just go there and you look at it and how to figure it out, right? So, and also YouTube is growing because of more and more things, like specifically what you're doing, even are all moving to these kind of media, right? It's not, even live sports, which was really important to traditional media, is moving to these kind of areas. So that's the second thing, is that it continues to grow there, and they haven't really. I don't think they monetize YouTube as much as they could. And they have a cloud business, which continues to grow. So they've got three really strong businesses. The fourth business, which no one gives them credit for, is Waymo, right? Which has far more data than Tesla ever has a robo-taxis all over the world, not all over the world, but in the United States. And they have lots of data. And so they value Tesla at some ridiculous multiple, but they won't give the same thing to Google. So those are the four things. Right. Digital advertising continues to grow very rapidly. It's well over a $500 billion business in this coming year. And Google has 30% of that business. Right. So, and people don't advertise in newspapers anymore. I remember getting the Globe and Mail. There used to be tons of advertising. There's nothing in it anymore. So the reality is that this is the way you advertise. This is the way you grow your business. And AI will have an impact on every one of those businesses. And they are a leader. Yes, they stumbled in all these other things, but they are one of the big leaders in AI.
It's so cheap. And that almost makes me nervous. Like, why is it so cheap? Because it is so dominant in all these places. And is it because, yes, they still have the market share in search. I'm ChatGPTing a lot more than every day. I do it more than I did the day before.
Yeah, but but the reality is that like a lot of traditional people still advertise on that area, right? And they're not going to go to ChatGPT because they may, and I'm not trying to say that it's not going to happen over a period of time, but I think when you look at the statistics on search, they're still one of the number one.
Yeah, for
sure. They haven't lost market share.
Yeah.
And at the margin, people like you and me may use those sort of things, but the vast majority of people don't, right? Especially on your phone and stuff like that. So, and I think that they've stumbled on a lot of things like AI and stuff like that, which has hurt them. And I think there's a real, people are really worried that, maybe they're Anthropic or one of these guys is going to take over search from them in a big way. I just don't see it happening, right?
Your second pick is Stryker. A little bit different, not a tech stock. Yeah. It makes medical devices.
Right. So Stryker does medical devices. It does knees and hips and spine business. They bought a company called Wright Medical that does hands and ankles. And so it's a great business because they're, for one thing, is that as the populations get older, they need more of these things, right? So we have much older populations, and they need hip surgery and all those things, and it increases the quality of their lives, right? A great deal. So that's one thing, and it keeps them out of hospitals, which is the other thing, and keep them off drugs. So that's the first thing. The second thing is that there's a bit of an annuity when you own Stryker from a surgical point of view, because surgeons don't kind of use one, knee thing and then the next day use another. They tend to stick with, because they're complicated little products to put together. And so once they learn how to use them effectively, they tend to use the same ones. The other thing is about 70% of Stryker's businesses in the United States, 20% of it is in the developing world, and then the rest of it is in is in undeveloped world, right? So there's lots of room to grow outside of the United States. Populations are getting older all over the world. And so that's a very important aspect of what they can do.
How much upside? It's already close to an all-time high.
Yeah, I mean, I think this thing compounds at a really good rate. I think there's a lot, well, I think it can do, 8 to 10% a year, but probably more, I would like to say. But I think it's a great business because of that. Like, it's just a really good compounding business, and more stuff is going to go to medical devices. And they do acquisitions, like they can do these tuck-on acquisitions constantly and grow their business that way too.
Is there going to be diminished need for hip and knee surgery because we're all taking Ozempic?
Maybe, but not as much as you think though, because those things deteriorate even in people who are healthier, right?
Your third one is interesting. It's a Canadian energy stock, Canadian natural resources. You don't like cyclical businesses. You don't like mining stocks, but you've got an energy stock in there. Why?
Right. So I like C&Q. I've owned for a long time, and I've always felt it's just been the best Canadian oil company around. Right. They've always executed incredibly well. When they've done new projects, they've always come in on budget. It's unbelievable that this is a very special company here. And the other thing that they're very good at is buying assets incredibly cheaply. Like, Suncor's done it, but these guys have done it, and they've done it incredibly well. So I like that aspect of it. The other thing I like about what's happening in the oil and gas industry is that they are, like many large cap oil companies, they just realize that they got religion or what, but they take their cash flow, which is a lot. They buy back their shares, they pay down their debt, right? And they reinvest in their business. Right. And I think those are the keys of what they've done over the last several years. And you can see the better returns that they're getting on their invested capital. Right.
And yet the stock's trading at a 52-week low. It is underperforming.
Right. So that's partly because of the price of oil, obviously. Right. So oil has been locked in.
Yeah, but it's underperforming peers as well.
Yeah. So, I mean, I guess it goes through these little periods of time where it does that. I think oil prices should be somewhere around between $80 and $90, and that's a fair value for oil. And so it's, below where it should be. In a world that's growing and everything's fine, right? Maybe that's not going to happen, but that's where it should be. But I think it's a company that you're not paying a lot for it, and you get a great dividend. And so it kind of pays you to hold it. But it's a really well-run Canadian business, right? And like I said, there's not that many of them around, but I think this is one of them.
All right, Paul, it has been so great to have you in studio. Thanks so much for joining me.